Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. So we got minutes of the last Fed meeting during the last session, and they seem to underscore worry over inflation. Most members of the Fed's rate committee saw upside risk to inflation as being greater than concern over a weaker labor market. In the meantime, in Asia, the CEO of Hong Kong Exchanges and Clearing is striking an upbeat tone when it comes to the return of international investors. And in a moment, we'll bring you our conversation with Bonnie Chan of HK Exchanges. But we begin here in the States. Joining me now is Tim Pagliara. He is the Chief Investment Officer at CapWealth. Tim is on the line from Nashville, Tennessee. Thank you, sir, for making time to chat with me. Can we talk a little bit about the Fed minutes and this concern over persistent inflation? Does that concern you at all?
Well, we have seen inflation in the 3% range this year, last year. It's no surprise. I mean, and the balancing act that the Fed has is they have to take a look at, as you suggested, in a recount of the minutes, they've got to look at employment, and then they have to balance that against inflation. So is inflation ahead of the 2% target? Yes, it's at 3%. And is it going to be a persistent problem? Well, we don't know. One of the candidates for the Federal Reserve talked this morning about the ratio of the size of the Fed's balance sheet at 20% of GDP and where we were the last time we looked at that. And, he would suggest that we had 2% interest rates. So the Fed can lower rates based upon their prior positioning relative to the Fed's balance sheet and where unemployment is, and suggesting that the full rate of unemployment is closer to 3.5%.
One of the things that struck me in the minutes from the last meeting, a couple of members of the committee noted concern about elevated asset valuations. Is that something that you share, that concern? I know we are enjoying a pretty expensive equity market. I think we can agree on that much.
We sure can. And I think most of the concern is channeled into all of the spending on artificial intelligence and data centers. And, some estimates now are that the amount of debt going into those centers and the whole space is somewhere around $3 trillion. It's an enormous amount of money. This morning, a couple of the commentators were talking about the parallel between where we are right now in the railroads in the 1800s. And, without really acknowledging it, that was a bubble too. So we are in somewhat of a bubble, just like we were in 1860. House of Morgan, JP Morgan went to the Rothschilds to borrow money, and they told them, you can't borrow a dollar, not a single dollar. Go back and clean up your mess. And then we got through that through consolidation, and then we went through this unparalleled period of economic expansion. So there are going to be some ebb and flows in this valuation. Most of the valuation is centered in things all related to AI, except some of the picks and shovels things that we really like, that we think will benefit from this tremendous amount of spending.
So for months now, we've seen mega cap tech lead the market higher. And as you pointed out, it's really about artificial intelligence and maybe by extension, cloud computing services. I think it's interesting that some strategists are now saying because these companies are extra heavily weighted, if we continue to see a rotation out of some of those names and into maybe undervalued elements of the market, that may contribute to a broader rout in the equity trade. Does that concern you at all?
No, not really. I mean, I think these things are all healthy. A correction during a period of overvaluation like we've seen in the last 4 or 5 days. Look at Palantir. I think it's down 17% in 4 days. But it had gotten very, very frothy. So I don't think it's a bad thing to see these companies, retrace more sustainable levels of valuation. But overall, I'm very optimistic, especially about broadening out the number of companies that participate in this market. And I think that'll sustain us because I think there's still a good appetite for equity.
So if you see a pullback in a name like Palantir down 16%, as you said, over the last 4 sessions, do you become a dip buyer then?
I wouldn't be, because our cost in Palantir is somewhere around $14. We sold 20% of our Palantir position in the mid 70s in January for tax purposes. We deferred that out, and we'll take a look at another sale, sometime in January. And we also, we've got free reign and qualified accounts, so we manage around the tax impact of that. But I don't think that's a particularly great buy right now. In that space, it's a great company, and they're doing all the right things. But again, valuation's ahead of what I think they can deliver long term.
So tomorrow morning, we're going to hear from Walmart, and I'm curious to get your take on what we may hear, not only about the tariff and the impact that may be having on margins, but overall how the American consumer is performing.
Yeah, and I think, we had mixed messages out of Target, especially with their CEO change. I think Walmart will stand out. They typically do well if we are going into a period of, tighter, budgets for the American consumer. They should perform very well. We had good numbers out of Home Depot this week. So, I'm not expecting anything but, a good middle of the road report out of Walmart.
I'm tempted to ask about whether or not you're seeing opportunities offshore. I mean, we can talk a little bit about the dollar if you'd like as a factor to consider when looking offshore in foreign markets. Is that something you're dabbling in at all?
We're looking at some ETFs. We missed, except for a small number of clients, we missed a big opportunity in Vietnam. In the height of all this tariff talk, in the midst of all the uncertainty, Vietnam was one of the first countries that cut a deal and came to the table. And the large cap Vietnam ETF's up 55% since April 20th.
How did I miss that?
I know. I think that the story on the tariffs is actually turning in to be a good one. We had an upgrade for the credit United States based upon the amount of revenue that is coming in from tariffs. I think that Vietnam, India, the countries that embrace free trade with us, they'll build a much stronger, sustainable economy than, say, China will at this point, because they'll be forced to turn within and focus on their own consumers. So I'm excited about that, especially the revenue. No business, no government can sustain itself long term unless it's appropriately financed. And the Trump administration took the position that a source of revenue through tariffs was better than taxing directly the American people and the production of their labor. And it's working, and we're generating a lot of revenue. The credit agencies are noticing it, and I think it's going to show up in our budget projections by this time next year.
We'll see where we go from here. Tim, it's always a pleasure. Thank you so very much. Tim Pagliara there. He is the Chief Investment Officer at CapWealth, on the line from Nashville, Tennessee, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Hong Kong Exchanges and Clearing posted record quarterly profit, a gain of 41%. Trading surged with average daily turnover nearly doubling, and at the same time, listings rebounded with IPO applications topping 200. The exchange's CEO, Bonnie Chan, told Bloomberg Television she's optimistic international investors are returning to Chinese assets, and that will keep momentum strong. Here is part of Chan's conversation with Bloomberg's Yvonne Mann.
Another quarter of record profit. You have trading that's been booming, and now more than 200 active applications on the pipeline. What stood out to you for this quarter?
What really stands out for me for this quarter is the fact that it's riding on a pretty sustained momentum. If you look at our results, this is actually another set of record half-yearly results. We deliver a pretty strong set already for the second half of 2024. And so for me, my biggest takeaway is that actually since I think September 2024, gradually we're seeing a return of interest from international investors, and they want to again look for opportunities to deploy more capital to this part of the world. You see it, I think, manifested in many ways, in our daily turnover, but also I think, in the way that all these investors around the world are participating in our IPOs.
The key question is it sustainable? You mentioned about average daily turnover, which you nearly doubled from a year ago. Yes. Obviously, with liquidity, has been quite ample with these southbound flows. Yeah. What could extend this streak?
Right. International investors are really, again, focusing on China assets. And I think as they try to come back to treasure hunt, it is a very good thing that we have equally a robust pipeline to match their appetite. I think that is very, very important. So you mentioned our pipeline. We have currently over 200 companies already having filed their applications. And in fact, on a daily basis, I'm speaking to a lot more. So I think, with the backdrop of, really the interest returning in earnest, as well as, all these very exciting investment opportunities coming online, I do hope that the momentum can carry on.
How confident are you that Hong Kong can reclaim the #1 IPO venue this year?
Yeah, people always ask me that question. I think it's certainly good to be sort of all the way at the top of the league table. I mean, at the moment, we're in a very good position, and we do have the pipeline to help us deliver and help us stay up there. But to me, the more important thing really is to make sure that we are able to support the fundraising needs of these companies. And this year, I keep talking about the IPO pipeline. I think we also need to look at the follow-on fundraising, which in fact has raised more money than the IPO proceeds. So year to date, we have raised about $16 billion, close to 17 for by way of IPOs. But we have actually more than $40 billion raised by companies already listed on our exchange. So to me, so long as we continue to support the fundraising needs of these companies, we continue to improve our listing framework.
Are you still doing a lot of marketing, or do you think companies are starting to come to you now?
Well, I think both. I mean, companies certainly, I think, saw how well we've done in the IPO space. And so I think on the average, I probably meet 2 to 3 companies per day, all sort of wanting to understand more what we have to offer. And I want to expand the universe a little bit. I think it's very encouraging that in the past few months, we have seen an increased appetite of companies beyond just the mainland China wanting to use Hong Kong as pick Hong Kong as their listing venue. So year to date, we've listed companies from Thailand, from Singapore, and there are more in the pipeline. So I certainly will do more in terms of this marketing activity.
There are those out there that do call this recovery you're seeing as something that's made in China, that what you're seeing in terms of the pipeline has been really driven by government policy, geopolitics. What do you say to those who say that?
Well, first of all, I don't think I'm surprised. I mean, just considering that China is the second largest economy of the world, and it's capable of producing so many exciting companies which investors around the world want to invest in, right? So to me, it's natural and totally understandable, this made in China phenomena. But that said, given that Hong Kong is an international financial center, and we stand in the middle as a super connector between mainland China and the rest of the world, what I would like to see is to really continue bringing more participants into the universe, whether they are international companies, international investors, mainland companies, mainland investors. I really want them to see Hong Kong as the main market they want to transact their business in.
We've seen a bit of a quiet resurgence in the A-share market, and the IPO market there seems to be coming back to life again as well. What does a rebound in Shanghai and Shenzhen mean for the pipeline here?
I think that will be very, very encouraging because the way I see it, we always say the capital markets is there to serve the real economy. So the fact that capital markets are doing well, should suggest that actually, there's a lot of positive momentum in the real economy as well. China is a big country. It is producing a lot of very exciting investment opportunities. I mean, you see our pipeline, right? It's really filled with a lot of excitement. And there's certainly enough for more than just Hong Kong to support. And I think increasingly I'm seeing the few exchanges in China, right? So Shanghai, Shenzhen, Beijing, and the Hong Kong market really playing a very complementary role. Now, for Hong Kong, I think one advantage we have is certainly the connection to the rest of the world. And therefore, for a lot of companies, when they decide to pick which venue to list, one thing which will gravitate them towards Hong Kong is if they have overseas expansion plans. And we actually saw that in a lot of companies which have been listed in the past few months. They want to raise proceeds. They want to therefore use the proceeds to expand overseas. And I think that is one thing which Hong Kong can actually serve the best.
That is Bonnie Chan, CEO of Hong Kong Exchanges and Clearing, speaking with Bloomberg's Yvonne Mann here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.